What if I told you that the price you see on your screen right now, the price of silver, is a lie? Not a small rounding error, not a minor discrepancy, a calculated, orchestrated, decades-long deception designed by some of the most powerful financial institutions on the planet. A deception so precise, so rehearsed, so deeply embedded into the architecture of global markets that most investors never even think to question it. They just accept the number, they trust the ticker, and that is exactly what the puppet masters are counting on. Right now, silver is trading at a price that has almost nothing to do with its actual physical supply, nothing to do with the staggering industrial demand that grows louder every single quarter, and absolutely nothing to do with the monetary crisis that is silently unfolding beneath the surface of every major economy on Earth. The price you see is a manufactured number, a stage-managed performance, a magic trick performed in broad daylight by banks who have mastered the art of pulling strings that most people cannot even see. And here is the part that should make you sit up in your chair. When those strings finally snap, and make no mistake, they are fraying right now, silver is not just going to rise, it is going to detonate. We are talking about a move towards $68 an ounce. Not in some far-off fantasy, not in some hypothetical doomsday scenario, but as the mathematical, inevitable consequence of a system that has been rigged so far beyond its breaking point that the correction will be violent, sudden, and historic. Stay with me, because today I'm going to pull back the curtain on the exact method banks use to suppress silver. I am going to name the mechanism. I'm going to walk you through the playbook step by step, and by the end of this, you will never look at the silver market the same way again. Let us start with the name itself. I call it the puppet string method because that is precisely what it is. Imagine a marionette hanging from a wooden cross. Every limb, every movement, every gesture is controlled not by the puppet itself, but by the hands above it pulling invisible threads. The puppet appears to move freely, it appears to dance on its own, but every single motion is dictated from above. That is the silver market. The puppet is the spot price. The strings are the paper derivatives, and the hands pulling those strings belong to a small cluster of bullion banks, primarily operating through the COMEX Futures Exchange, who have turned price suppression into both an art form and a profit engine. Here is how it works in its most basic form. These banks do not need to sell physical silver to drive the price down. They do not need to flood the market with real metal. All they need to do is create enormous volumes of paper silver contracts, contracts that represent silver that does not exist, has never been mined, and will never be delivered. They dump these contracts onto the futures market in concentrated bursts, often during the thinnest trading hours when liquidity is at its lowest, and the algorithm-driven market does the rest. Prices collapse, stop losses trigger, retail investors panic, and the banks scoop up the carnage at discount prices. This is not speculation. This is not a conspiracy theory. This is documented. It has been investigated. It has been fined. And it continues to this day because the fines are pocket change compared to the profits, and because the regulatory bodies tasked with policing these markets are, in many cases, staffed by the very people who used to run the trading desks. To understand the scale of this manipulation, you need to understand one number, the paper-to-physical ratio. This is the ratio of paper silver contracts trading on exchanges versus the actual physical silver available for delivery. And that number, depending on which analyst you consult and which exchange you examine, ranges anywhere from 100 to 1 all the way up to 400 to 1. Let that sink in for a moment. For every single ounce of real, tangible, physical silver sitting in a vault somewhere, there are potentially hundreds of paper claims against it. Imagine if your bank told you that for every dollar in their vault, they had promised that same dollar to 400 different people. You would call that fraud. You would call that a Ponzi scheme. But in the precious metals market, it is called business as usual. This paper avalanche is the core mechanism of the puppet string method. It creates the illusion of abundant supply when in reality, the physical market is tightening dramatically. It allows banks to set the price not based on what real buyers and sellers are doing in the physical world, but based on the volume of fictional contracts they can generate with a keystroke. Think about that. The price of one of the most critical industrial metals on Earth, a metal used in every smartphone, every solar panel, every electric vehicle, every missile guidance system, every medical device, is being determined not by the people who mine it, refine it, or use it, but by traders in New York and London who have never touched an ounce of physical silver in their lives. They are setting the price of something real with something imaginary, and the world just goes along with it. Now let me take you inside the actual mechanics. The specific technique most commonly used is called spoofing. And while the word sounds almost playful, like some kind of prank, the reality is anything but. Spoofing works like this. A bank trader places an enormous sell order on the COMEX exchange. We are talking thousands of contracts, each representing 5,000 ounces of silver. That single order can represent tens of millions of dollars worth of metal. The order sits on the order book for everyone to see. Every algorithm, every high-frequency trading bot, every institutional desk sees that massive wall of selling pressure, and they react. They pull their buy orders. They start selling. Momentum shifts, the price drops, and then right before that enormous sell order would actually execute, the bank cancels it. The order was never real. It was a phantom, a ghost, a bluff designed to trigger a cascade of selling by everyone else in the market. The bank never intended to sell at that price. They wanted everyone else to sell. And once the price has been driven down by that panic, the bank quietly steps in on the other side and buys at the newly discounted price. This is not theory. JP Morgan Chase paid over $900 million in fines and penalties in 2020 for precisely this kind of manipulation in precious metals markets. Their traders were caught spoofing thousands of times over a period of years, and JP Morgan is not the only one. Deutsche Bank settled similar charges. Bank of America, UBS, and others have all been implicated in various forms of precious metals manipulation. These are not fringe accusations from conspiracy websites. These are findings by the Department of Justice, the CFTC, and international regulatory bodies. But here's the critical question most people never ask. If the banks were caught doing this, and if they paid hundreds of millions in fines, why would anyone believe they stopped? The fines represent a tiny fraction of the profits generated by years of manipulation. It is like fining a bank robber $10 for stealing $1 million. The incentive structure has not changed. The mechanism has not been dismantled. The puppet strings are still there. They have just learned to pull them more carefully. There is another layer to this that most people never even hear about, and it is arguably even more brazen than the COMEX spoofing. It is called the London Silver Fix, now renamed the LBMA Silver Price, in an attempt to wash away the scandal, but the mechanism has barely changed. Twice a day, a small group of banks participate in a process that literally sets the global benchmark price for silver. This is the price that mining companies use to value their reserves. This is the price that industrial buyers reference in their contracts. This is the price that central banks use when valuing their holdings. And it is determined in a process that, for decades, was conducted via a private phone call among a handful of banks. Deutsche Bank withdrew from the London Silver Fix in 2014 amid manipulation lawsuits and investigations. The entire process was overhauled, supposedly made more transparent, and handed to new administrators. But the fundamental problem remains. A small group of participants with massive trading positions and enormous financial incentives are involved in setting the very price at which their trades will be valued. The conflict of interest is not hidden. It is structural. It is designed into the system. Multiple lawsuits have alleged that participants in the London Fix coordinated to push the price down during the fixing window in order to profit from their derivative positions. Some of these cases resulted in settlements. Others are still winding through courts. But the pattern is consistent and damning. At the exact moment the price is being set, unusual trading activity drives prices lower every single time. The statistical probability of this occurring naturally, without coordination, is essentially zero. Now you might be asking why. Why would some of the most powerful banks on earth devote this much energy, this much capital, this much risk to keeping the price of silver down? And this is where the story goes from disturbing to downright alarming. Silver is not just an industrial commodity, it is money. For thousands of years, silver was the most widely used form of money in human civilization. More transactions throughout history have been conducted in silver than in gold. The word for money in many languages is literally the word for silver. In French, argent means both money and silver. In Spanish, plata serves the same dual purpose. Silver is not a relic of the past, it is a monetary metal with a lineage that stretches back to the earliest days of organized civilization, and that is precisely why it must be suppressed. If silver were allowed to trade freely, reflecting its true supply and demand fundamentals, it would send a signal so loud that it would shake the foundations of the current financial system. Rising silver prices signal inflation. They signal loss of confidence in fiat currencies. They signal that the money printing, the deficit spending, the debt accumulation that governments and central banks have engaged in for decades is catching up with them. A rising silver price is a flashing red alarm that says the emperor has no clothes. It tells the world that the dollar, the euro, the yen, and every other fiat currency is losing purchasing power. And the people who benefit most from the current system, the banks, the central banks, the governments that fund themselves through debt, they cannot allow that alarm to ring. So they mute it, they suppress it, they pull the puppet strings every time silver tries to tell the truth. This is not just about profit, although the profits are staggering. This is about control. Control of the narrative, control of the monetary system, control of the mechanism by which wealth is measured and transferred. If silver breaks free, it does not just hurt the banks that are short, it undermines the credibility of the entire paper money system that the modern global economy is built upon. Here is where the story takes its most dramatic turn. Because while the paper market has been held down with artificial pressure, the physical market has been telling a completely different story. And the divergence between these two realities has reached a level that is simply unsustainable. The Silver Institute has reported that the global silver market has been in a structural physical deficit for multiple consecutive years now. That means more silver is being consumed than is being mined and recycled combined. Think about what that means. Every year, the world uses more silver than it produces, and the gap is not shrinking, it is growing. Industrial demand alone is staggering. The solar energy sector is consuming silver at a rate that would have been unthinkable a decade ago. Every solar panel requires silver for its conductive pathways. As the world races to build out renewable energy infrastructure, silver consumption from this sector alone is projected to grow dramatically throughout this decade. Electric vehicles use significantly more silver than traditional combustion engine cars. The rollout of 5G networks requires silver. Artificial intelligence and the data centers powering it require silver. Military applications require silver. Medical technology requires silver. Meanwhile, on the supply side, there has been chronic underinvestment in new silver mining projects for years. Most silver is produced as a byproduct of mining other metals like copper, zinc, and lead. There are very few primary silver mines in the world. The geological grades of existing mines are declining, meaning it takes more rock, more energy, and more capital to extract the same amount of metal. Lead times for new mining projects are measured in years, sometimes decades, so you have a market where demand is exploding, supply is constrained and declining, physical inventories are being drawn down year after year, and yet the price is being held artificially low by paper contracts that represent silver that will never be delivered. This is a coiled spring. And when it releases, the energy stored in that compression will produce a price move that will be talked about for generations. So why $68? Why not $50? Why not $100? Let me walk you through the reasoning because this is not a number pulled from thin air. It is grounded in multiple converging factors that all point to the same conclusion. First, the gold to silver ratio. Historically, this ratio has averaged somewhere between 40 to 1 and 60 to 1. At various points in history, it has been as low as 15 to 1, which was the ratio set by many governments when both metals were used as official money. Today, the ratio has been hovering significantly above its historical norms. If gold is trading at levels suggesting significant upside, and the gold to silver ratio reverts even partially toward its historical mean, the mathematical result puts silver well above $60. Second, inflation adjustment. Silver reached nearly $50 an ounce in 1980 and again briefly touched that level in 2011. If you adjust the 1980 high for inflation using the Consumer Price Index, the equivalent price today is well north of $150. Even using more conservative inflation metrics, the inflation-adjusted equivalent is dramatically higher than where silver trades today. At $68, silver would still be historically cheap in real terms. Third, the supply deficit trajectory. If the current rate of deficit continues, and there is no indication it will reverse given the structural demand drivers I described, COMEX-registered inventories could face severe strain. When the available physical silver for delivery against futures contracts drops below a critical threshold, the paper price suppression mechanism breaks. It does not degrade gradually. It breaks suddenly and violently because the entire system depends on the fiction that paper contracts could theoretically be settled in metal. When that fiction becomes obviously untenable, the repricing happens virtually overnight. Fourth, consider the behavior of central banks and sovereign wealth funds. While the public narrative focuses on gold, there is growing evidence that strategic buyers are quietly accumulating silver. Several nations have been increasing their reserves. Industrial users are beginning to secure future supply through long-term contracts, a sign that they see the writing on the wall. When sophisticated buyers start hoarding, it accelerates the physical squeeze and makes the eventual repricing even more violent. $68 is not the ceiling, it is the floor of the first major repricing event. It represents the point where the paper manipulation can no longer contain the physical reality. And once that dam breaks, the move beyond 68 could be astonishingly fast. There is a reason this is happening now, and not 5 years ago or 10 years ago. Several converging forces are simultaneously weakening the puppet strings in a way that has never happened before. The first force is the physical silver migration from west to east. Enormous quantities of silver are flowing from western vaults, particularly from London to eastern markets. India has been importing silver at record-breaking levels. China's industrial consumption is vast and growing. This physical metal is leaving the Western banking system and entering hands that have no intention of leasing it back or allowing it to be used as the foundation for paper leverage. Every ounce that moves east is an ounce that can no longer support the paper structure. The second force is the rise of informed retail investors, the silver squeeze movement, the growth of precious metals communities, the proliferation of independent analysts and researchers who are documenting the manipulation in real time. All of this is creating a level of awareness that did not exist even 5 years ago. Retail investors are buying physical silver and removing it from the system. They are draining dealer inventories. They are requesting delivery from COMEX. Every ounce removed is another thread pulled from the puppet strings. The third force is the monetary environment itself. Global debt levels are at historic highs. Central banks have painted themselves into a corner with years of extraordinary monetary policy. Inflation has proven far stickier than policymakers hoped. The credibility of fiat currencies is eroding, not rapidly enough for most people to notice day to day, but steadily and unmistakably. As this erosion accelerates, the demand for tangible monetary assets like silver intensifies, putting even more pressure on the already strained physical market. The fourth and perhaps most significant force is that the BRICS nations and other emerging economies are actively building alternatives to the Western-dominated financial system. De-dollarization is not a slogan. It is a process that is underway, accelerating, and involves nations representing a significant portion of the global population and economy. As alternative settlement systems emerge and gold and silver regain roles in international trade and reserve management, the ability of Western banks to control precious metals pricing diminishes. So where does this leave the individual investor? The person watching this right now, trying to make sense of a financial system that seems increasingly disconnected from reality? It leaves you at a crossroads that very few people in history have had the privilege of standing at. You are living in a moment where one of the most undervalued, most manipulated, most strategically critical assets on the planet is available at artificially suppressed prices. The manipulation that has kept silver cheap is the very thing that has created the opportunity. Without the suppression, silver would already be trading far higher, and the upside from here would be far smaller. In a twisted sense, you should almost be grateful for the manipulation, not because it is right, not because it is fair, but because it has created a window of opportunity that is historically rare. You are being given the chance to acquire real, tangible, monetary metal at prices that do not reflect its true value, its true scarcity, or its true strategic importance. But this window will not stay open forever. The physical deficits are real and growing. The Eastern demand is relentless. The monetary system is under strain. The puppet strings are fraying. And when they break, the repricing will be swift, and those who waited for confirmation will find themselves chasing a price that is already gone. I am not telling you this to create urgency for its own sake. I am telling you this because the mathematics do not lie. Supply and demand curves do not care about manipulation in the long run. They can be bent, twisted, and distorted for a time, but they cannot be permanently broken. And the longer the distortion persists, the more violent the correction becomes when it finally arrives. Let me leave you with this thought. Every system of control, no matter how powerful, no matter how deeply entrenched, has a breaking point. The puppet strings that banks have used to control the silver price are not made of steel. They are made of confidence. Confidence that paper contracts represent real metal. Confidence that the game can continue indefinitely. Confidence that the physical market will always accommodate the fantasies of the paper market. That confidence is cracking. You can see it in the declining COMEX inventories. You can see it in the premium spikes at retail dealers. You can see it in the record import numbers from India and China. You can see it in the nervous energy coming from bullion bank trading desks. The cracks are visible now if you know where to look. $68 is not a prediction. It is a destination. It is where the price must go when the paper facade can no longer contain the physical truth. And the journey from here to there may be the single greatest wealth transfer opportunity of our generation. The question is not whether the puppet strings will snap. The question is whether you will be positioned on the right side of the trade when they do. The banks are pulling their strings harder than ever, suppressing with everything they have, because they know the end is approaching. Their desperation is not a sign of strength. It is a sign that the game is nearly over. Silver has been telling the truth in whispers for years. Soon it will shout. And when it does, the sound will be deafening. Do not let anyone pull your strings. Do your own research. Understand what you own and why you own it. And above all, understand that in a world built on paper promises, the most dangerous thing you can do is own something real. Thank you for watching. If this opened your eyes, share it with someone who needs to hear it. Like this video, subscribe to the channel. And remember, the puppet masters only have power as long as the audience does not see the strings.